Our final discussion in sales is going to focus on what your book calls advanced remedies. And essentially what this is how do we deal with lost profits in a UCC context, either the seller's lost profits or a middleman buyer's lost profits on future sales, or in the case of the seller, a lost volume seller and the losses that they face when a buyer backs out of a deal. So you'll recall the many remedies that a seller has, some of which involve forcing the buyer to actually take and pay for the goods, the most common ones of which revolve around reselling the goods to a different buyer and suing for the price difference, or claiming the market price difference for goods. Today, the cases that we're going to read are focusing on Section 27082 of the UCC with respect to sellers, the loss volume seller scenario. So that's what we're going to focus on today. So for situations where the resale price or market price might be insufficient remedies. For instance, scenarios where the resale price or the market price essentially is the contract price, and the seller would resell for the same price as was set in the breached contract, and the seller has so many goods on hand that essentially its supply can meet the continuous demand for the goods, then the seller has a claim that, well, resale doesn't really work because I would have sold to that guy anyway. Your backing out of the contract just means a pure loss of profits for me. So in essence, the argument that the seller has to make and convince a court of is that the seller would have made the sale both to the breaching buyer and to whatever other party in a normal scenario would have been the substitute buyer. Right? So I just would have made both of those sales anyway. And if that's the case, then the seller should get some measure of lost profits, right? That expectation in this case accurately reflects this notion that the profit margin that we lost out on, that as a seller is really what we expected to make in this scenario. So your textbook goes into some of the history as to why courts don't really seem to use the actual calculation that appears suggested by a plain reading of the UCC, right, which is essentially the credit for cost reasonably incurred and payments or proceeds at resale are for sellers who manufacture component parts for someone else. If a buyer repudiates, it's hard to sell the exact goods, so the seller/supplier basically has to break the parts down for scrap. And your text illustrates at some length that perhaps the easiest way to think of those situations is as a resale under 2706, where we're looking at the contract price minus the scrap sale price plus incidentals and subtracting any savings in manufacturing costs from stopping in the middle of a manufacture. Another question that your textbook discusses, but I think more or less dismisses as more theoretical than practical, is whether there's some way to tell when it's reasonable for a seller to stop production upon buyer's breach rather than continue to make the goods. And so it gives a discussion of this formula of marginal cost of completion being less than, right, the resale value of the finished product minus the scrap value. So, for example, let's say it would cost $100,000 to complete manufacturing of a product, and the resold goods would sell for $150,000, but the scrap value would be $60,000. So in that scenario, you would have on the one side $100,000 compared to $150,000 minus $60,000, or $90,000, right, when you do the math out. And so in that scenario, it would make more sense just to stop manufacturing the goods and to sell them for scrap. The problem is that in the real world, it's almost impossible to know for certain what the actual cost to complete production will be or what you'll get in scrap value. So in the real world, what usually happens when somebody alleges, oh, seller, you should have just stopped manufacturing the product, that would have solved the problem, is a subjective reasonableness test. So the cases that your book includes really look at this debate around what 27082 says is essentially the expectation measure in a lost volume seller scenario. The measure of damages is the profit, parentheses, including reasonable overhead, which the seller would have made from full performance by the buyer. And then, as we just talked about, together with any incidental damages provided in this article, due allowance for costs reasonably incurred, and due credit for payments or proceeds of resale. So the first case involves Shore Trip and Westinghouse Engineering. And this illustrates an argument between parties about which fixed costs in the manufacture of goods can go into calculating the cost to produce those goods for purposes of establishing sellers' costs to produce and thus making the case for lost profits. So this will be a situation where the buyer who is in breach will be arguing that seller actually has lots of costs associated with manufacturing an item. And so the profit would have been small, resulting in a smaller damage award that the buyer has to pay if they breach and the court determines that the seller should get lost profits. So Shore Trip's interpretation of the agreement they had with Westinghouse was that any time that Westinghouse ordered fewer than 300 kits that Shore Trip was making for them within a 3-month period. And so anytime Westinghouse ordered fewer than 300 kits, then Westinghouse would have to pay damages as if they had ordered 0 kits, no kits, or almost $40,000, $39,900. The lost profits on the kits, Shore Trip argues, is about $530 per kit times 1,200 kits is $596,000 odd dollars. All right. Now, Westinghouse looks at the manufacturing of these kits and undoubtedly through the process of discovery finds out that for the 611 kits of this nature that Shore Trip had sold, they only reported a net income of about $12,000. All right. So Westinghouse is pointing out, look, you're saying that we owe you profits on 1,200 kits of over $500,000. But if you look at what it seems like you were actually profiting on making half that amount of kits, right, 611, you only made 12,000 in profit. So you must have tremendously variable manufacturing costs here. Now, Westinghouse had committed to a certain volume of kits to purchase from SureTrip. They had fallen massively short, and SureTrip did get damages at trial, but they didn't get these lost volume seller damages that they really wanted. SureTrip is claiming lost profits here, but there's a big dispute as to, as I just illustrated, how they're going to calculate it. SureTrip's claiming really high profits. Westinghouse claims that no, your profits really look like they were quite small. So SureTrip's response, essentially to the Westinghouse arguments, is, well, we were already operating at break even, so these additional kits we were going to sell you wouldn't have involved any extra expenses on our part to manufacture. And the court ultimately goes with Westinghouse's argument. The trial court uses the tax returns of SureTrip to calculate that it was really only about $20 a unit that SureTrip was getting in profit. And the appellate court, looking at it, suggests that SureTrip was lucky that the trial court even used the tax figures, given the lack of evidence that SureTrip presented about what profits they really thought that they were going to get. So I'll let you, dig into this if you want more minutia. I don't want to overcomplicate the idea here, but the basic takeaway that you'll see from this case is that you're always going to have the manufacturer, the seller, making an argument in a lost volume sales situation that, oh, our cost of production are actually quite low, so our profit was going to be high. And the buyer trying to flip that and say, oh no, actually your profits were very small, so if I even owe you lost profits, it should be a small amount. All right, in our nursery case, we have a wreath maker, seller, and a nursery, Frank's Nursery, the buyer. The buyer reduces their requested order after initially giving a very large order to William Young. The trial court and the jury in this case found for the seller, found for the producer, and awarded about $133,000 in damages. The appeals court reversed, saying that the trial judge improperly indicated that the defendant, the buyer here, had the burden of proof that stopping production of pine boughs was commercially unreasonable. Because part of their argument was, look, you, the seller, should have just stopped producing pine boughs when we let you know that we were shrinking the order, right? The essential claim here is that it's not that the defendant has the burden of proof that Young was behaving unreasonably. It's that Young, the seller, should have to prove to the court that the choice that he made was reasonable. The case is a first impression in Ohio where it was decided, but the court looks at various treatises and says, well, the treatises seem to say that the burden is on the breaching buyer to show that the seller's actions were commercially unreasonable. All right. And it seems like here what the court is doing is combining the 2708 seller's damages and the 2704 rules about identifying specific goods to a contract, and then looking at the jury instructions. So in the jury instructions in this case, the trial judge had said, if you think the decision to halt production, in other words, not to produce and try to sell the goods to others, was commercially unreasonable, the jury should use market price damages under 27081. But if the jury thought the decision to stop was reasonable, it should use the lost profits measure in 27082. And so the Ohio Supreme Court reversed the Court of Appeals, reinstated the jury award in this case. And so because mitigation was an affirmative defense, they say the trial judge was correct in placing the burden on Frank's nursery to show that Young's decision not to complete cutting all the evergreen boughs originally ordered was commercially unreasonable. We'll discuss the problem 24.1, looking at seller's remedies, in class. Let's move on to talking about buyer's lost profits. And really what we're focusing on is consequential damages for middleman sellers. And the cases that you have on this topic really are just looking at different illustrations of arguments made for lost profits and defenses that the buyers face, or at least claims that the buyers face from the sellers, that yes, we breached, you suffered some sort of damage, but we really don't owe you as much in consequential damages, which, remember, buyers are entitled to consequential damages clearly under the UCC. We, the seller who breached, don't owe you as much as you claim. The Jetpack case was, a chain of suppliers and sellers. And ultimately, the dispute is between these two middlemen in the chain, Bostech, who was trying to get into the computer business, and Jetpack, that had a specialty in exporting goods to Russia and sort of wanted to break into the Russian market. And so they were going to get computers from Bostech, and then Jetpack was going to export them to their contacts in Russia. Well, Bostech provided faulty computers. Jetpack's relationship with its Russian buyers was destroyed. And although the contract between Jetpack and Bostech only dealt with 100 computers, ultimately Jetpack had anticipated selling at least 3,000 computers to its Russian buyer. And so what it is seeking from its seller is lost profits for future sales. And so the court discusses a lot of potential damages that the buyer could potentially claim here. Incidental damages like having to fly to Moscow to mollify their clients, shipping costs, and then the consequential damages, the big one, the loss of the additional 2,900 computer sales. And says that, Jetpack should get their incidental damages and lost profits. So you see how these consequential damages can be really valuable to a buyer if they can get them. The Texpar versus Murphy Oil case is a really interesting one, I think. So we have our original plaintiff Texpar, our original defendant Murphy, and Texpar had arranged to buy 15,000 tons of asphalt at $53 a ton. and sell it, just flip it, at $56 a ton. Murphy Oil repudiates after delivering only 690 tons, and Texpar ends up allowing Murphy to negotiate directly with Texpar's intended buyer, it was called Starry, and the intended buyer, Starry, buys the remaining oil that it needs, or asphalt, petroleum product, from Murphy at $68.50, right, a ton. Texpar agrees to pay the difference, right, between the $56 a ton that it was going to sell to Starry at and the $68.50 a ton that Starry eventually ended up negotiating with Murphy Oil. So, in short, right, Texpar ends up on the hook to its downstream buyer to the tune of $191,000. Right. The claim here, which is interesting, ends up being one for market damages. Right? So the jury ended up calculating damages as the difference between the market price, which had shot up, it was $80 a ton for asphalt, and the contract price that Texpar expected to pay Murphy, which was $53 per ton, of the undelivered asphalt at the time of the breach. So the total damages that Texpar ended up getting, right, was $386,370. And so the Murphy Oil looks at that and says, that's way out of proportion to what Texpar ended up paying in consequential damages to its downstream buyer. And even if you add in the lost profits, the $3 a ton that Texpar expected to make on its deal. This is the top of page 517, right? Texpar's award far exceeds its out-of-pocket expenses and lost profits occasioned by the repudiation. Right? So the fact that the court instructed the jury to give market price damages doesn't make sense. This is an expectation. This is a windfall. Right? They expected to make $45,000, flipping 15,000 tons of asphalt with a profit of $3 per ton. They had to pay $191,000 in damages to their downstream buyer. But even if you add those together, that's over $150,000 less than what the jury awarded them using this market price calculation. Now, the court says, well, too bad. Right? There's policy reasons why market damages exist under the UCC. It's to discourage sellers from repudiating contracts when market prices rise. It helps promote uniformity by calculating damages as of the date of the breach. Right? And so their argument is essentially too bad. Right? This is a form of damages that they are allowed to elect. And interestingly, sort of a weird wrinkle, because of the way that this was structured, it does turn out, in the actual structure that they didn't get a substitute. right? The buyer didn't really cover, right? Now, Murphy's feeling on this, and I think you can see how it makes sense under the circumstances, is, well, they sort of did cover. They let us step in and arrange the cover. But, at the end of the day, there's very much the sense here in this court's calculus that you breached as a seller and you should be on the hook, right, for whichever remedy in terms of damages that the buyer is eligible to elect and does elect under the UCC. The final case involves calculating actual damages. Right? So we have our seller, KGM, and Fresh Networks, their buyer. Price of lettuce goes up. KGM refuses to sell lettuce to Fresh. Fresh covers on the open market, and KGM is disputing the damages that Fresh is claiming. All right. Why? Well, because the contract involved was a cost plus contract. All right. So because it was a cost plus contract, the argument is, in terms of the downstream losses, they only had to eat $70,000 in additional costs. And so otherwise it's a windfall because they're getting the difference between the cover and the contract price. And that isn't appropriate here because the buyer can pass along its extra costs to its downstream buyers. The court looks at a case called Allied Canners, which KGM, it seems, argued was authority about the sale of raisins. Right? And there the court said that because the seller knew there was a resale contract, the buyer was not liable for damages on its forward contracts. So let me reframe that. Essentially, because the seller knew that its buyer wasn't going to be liable for damages on its downstream, the forward contracts, that there was no bad faith on the part of the seller for not selling the goods, that contract market damages were not appropriate. Right? The court here says, look, good faith, bad faith on the part of the seller, that's immaterial. One of the options that a party may choose is cover as a buyer, and that's what we're going to enforce. Right? If they have structured their downstream contracts in a way that's beneficial to them, good for them. All right. We will talk about both this reasoning, this sort of allied canning approach reasoning, where, if there's, no harm, no foul, how do you treat that? Do you allow the buyer, who is the victim of a breach, to essentially get a windfall through their cover? Or in the case of the Murphy oil, do you allow the buyer to get a windfall because of the market price difference? We'll see those illustrated, and we'll talk about those in the context of our discussion problems for this section. So have a lovely evening. I will talk with you tomorrow night.